Hello, everybody. Welcome to Friday, another Talk Money with Tom show. Today, we are here to answer your questions. We want to try to help you have a better retirement, and we do that by answering questions. You can send them in. Ask Tom at talkmoneywithtom.com, an email. Send them in now. We can answer them live. You can go to the chat and put in any questions you want, and we'll try to answer those. Of course, you can send them in during the week. We answer questions that came up from clients during our strategy sessions and such too. So really, we're trying to help people understand, retirement planning, how to manage your money, and how to manage your taxes during retirement. All of these things should help you financially. And so we have this channel, Talk Money with Tom. We started it mainly because we really wanted everybody, including our clients, to have a higher level of education around these subjects. And we have over 1,200 videos on there now, so feel free to go look at those. And you can subscribe to the channel and hit the little bell button. You'll get notified when we put out new content. And so I think that's really important. It's something that really isn't taught in schools and what have you, is how to handle yourself financially. Even if you have an advisor, I think it's a good idea to get your knowledge base up as high as possible. And then, of course, if you want to just meet with us and have us talk to you, maybe on a custom basis, answer some questions, you can go to our website, book appointment buttons up in the corner, and our schedule's live. Set up a 30-minute time to meet with Ethan and I, in office, a video, phone call, whatever works best for you. I'll be happy to talk to you about your specific situation. So at the beginning of our show, we always like to do a summary of kind of what we saw happening in the stock market this week. And so let's take a look at our chart here. So pretty good week so far.
Yeah, like a record-setting week, you could say.
Yeah, last Friday was fun because right at the end of the show, we closed, the market closes at 1 o'clock here, and, we closed at the all-time high for the first time in a little over 2 years. And we've, done that every day since. Monday, Tuesday, Wednesday, Thursday. Just before I came into the show here, we were a little over break even, so we might do it again today. We'll see what happens. I think Intel today, the report from Intel kind of brought the market down. It was up like 0.5% this morning. And so what's been happening this week, there's been some good data that's come out that's really kind of driving the market. And one thing I want to talk about, because this doesn't get talked about enough, is that the data that's coming out now that is good is the reason the market has been going up.
Yep.
Not particularly the reason the market is going to go up. And this is a distinction that a lot of people don't understand. The market is a leading indicator. The leading economic indicator, LEI, is a basket of 10 different indicators, and the S&P 500, which we're looking at right here, is one of those 10 because it has a propensity to lead the economy, right?
Yeah. You buy for the future, you don't buy for the now.
Yeah, so hey, we set a new high every day this week. And so to me, that does mean that there's some follow-on aspect of that the market is telling us that things are going to be okay. And it's been telling us that for quite a while, right? And if we go back to October of 2022, the 13th is where we hit that low, in that downturn. We had that big 10% drop last summer, ended at the end of October. But generally speaking, we've had this primary trend to the upside, even though everybody was saying it wasn't going to do well, the market was going to do poorly, the economy was going to do poorly. And we'll cover some of the numbers here. And here's a big thing that I've been talking about so far this year is that I'm running into an awful lot of people who still think the economy is doing poorly.
Yeah, there's kind of a disconnect how the stock market, the economy is doing, and how people feel.
Yes, definitely. Now, part of the reason I think people feel the economy, and just my experience of talking to my clients, that they feel the economy is doing poorly is because they're seeing costs go up at a fairly rapid rate, and that's making it difficult for them to have the same standard of living that they're used to because, everything that they're going to the grocery store, the electric bill comes in, all these things are higher.
When your purchasing power is getting eroded, you don't feel as good about the economy. You don't feel as comfortable.
That's right. And ironically, one of the reasons that you might see higher costs is because the economy is actually quite good. Because when the economy gets hot, the demand can outstrip the supply. In this particular case, the supply was subdued due to the pandemic, right? And so supply of goods was subdued, and so people were kind of bidding up, the refrigerator or whatever they were doing, their kitchen remodel, right? And then after we got out and got to do services, there weren't enough people working in these places. And so we had subdued, employees, really, in that case. those have started to ease and ease and ease. And so today, the reason the market was up, 0.5% right away was because we had the PCE, Personal Consumption Expenditure Index report. And so this is a chart that kind of shows what was happening here, in the last, since 2020. And you can see that big jump, right? Big hump. And so what happened was, we'll put out too much money, most likely, right? Combine that with the pent-up demand of being locked up and people wanting to do things to feel better, and then as soon as they can getting out and travel, right? And we ended up, that combination of wanting to spend money, even if you didn't have it, and having a lot of money because the government was putting it out, and then a restricted supply because of a pandemic, you had very high inflation.
Yeah, because people weren't able to spend on travel or stuff like that, so they saved a lot of extra money, and now it's kind of burning off the reserves.
Yeah, exactly. And so there's several lines here. First, the dark blue line shows the change from the year earlier. So the report today showed that the PCE Index, and again, this is the core portion. This doesn't include energy and food. And the reason we talk about core is because this is what the Federal Reserve looks at. They're not looking at CPI. They're not looking at top line inflation. They're looking at core PCE, right? And when they're talking about 2%, and so that yellow line there, that horizontal yellow line, is the Fed inflation target at 2. And so we're still above that compared to last December, right? 2.9 versus 2. But if you look at the last 6 months, which is kind of that greenish line, that's actually now below 2%. So at 1.9%, take the last 6 months, multiply times 2, it's 1.9%. We're rounding here, but nonetheless, it's already below that. And if you look at the last 3 months and annualize that out, we're actually at 1.5%.
Yeah, which is a bit too low.
That's right. And so if you look at what the Fed looks at, they don't really like to see inflation in this particular case get below 1.75%. And so that is an issue for the Fed because they are, as nervous as they are about inflation, they're actually more nervous about deflation. At least that's what we've talked about in the past. And so you'll actually see, you can see a deflationary trend there, where it got down, below zero back in the pandemic when things were really locked down. And that's why they took rates to zero. It's why they started to buy literally billions and billions of dollars worth of bonds, on the open market and what have you too, what's called quantitative easing, to try to push away from that. Of course, doing quantitative easing, lowering to zero, and the Congress putting out tons of stimulus created the opposite effect. We ended up one of the greatest stock market runs really in history, and then of course that created this inflation, which has created this downturn. So now inflation is really subdued. The argument is now, when are we going to have a rate cut? Right? And so the market, for a point in time had over 80% chance that we would have a rate cut in March. Now that's down to kind of 52%, sort of a coin flip. Right? Not so sure on that. Although I will say, if you look at the last 3 months and we're hitting at 1.5%, if we continue to see numbers that drop, maybe by March, we do see some, at least consideration. Because right now, the Fed governors are talking about rate cuts in kind of that July to September timeframe, right? And I would think the market won't like that. It didn't like the fact that the Fed waited so long to raise rates. And part of the reason we have this higher inflation is because they delayed rate increases. You could have kind of a soft economy, a really soft economy, if they leave rates up too long.
Yeah, so the fear is that they're just not reacting in time.
Yeah, exactly. So these are things, we can look at, what's happening with the economy and those type of things. But you look at the stock market, the expectation right now is that they're going to be lowering rates at some time in the first half of this year, definitely. And so that's where you could get a hiccup, right? The market's moving along because they're going to be lowering rates, and we got a good economy and what have you, things are happening, and all of a sudden, they don't. And so I think that will be a picture. However, I don't think it'll be a big picture. This is the 5-10% type of correction that would happen. This isn't the 2008 thing. These aren't the big ones, okay?
Nothing systematically is breaking in the system. It's more that there's slight corrections.
Right. Something could break. And if they leave it up long enough, maybe that happens, and you got some of these companies that are kind of teetering, with their high debt levels and those types of things. But so far, and again, this is back to one of my themes, is that 2008, Lehman Brothers breaks. They don't bail out Lehman Brothers. We end up with a 30% stock market drop, and we end up putting out like $7 trillion worth of stimulus to get us out of that. And this time, last year, regional banks basically break, right, under the load of the higher interest rates. And what do? They set up a special lending institution for those banks and basically throw money at it. They didn't let it fail. They let some of the banks fail, but they didn't let the system fail. And the market just basically took off. And we had a 24% year last year because of that, instead of the big downturn that everybody was expecting after something broke. And what I don't think what they're realizing, there's two big things that are my theme. Number one, they're not realizing what a pandemic does to the finances and how much pent up demand and how much people are willing to spend. And consumer spending is driving this whole thing. And number two, they basically don't realize what the government has now discovered they can do, especially in an election year, right? We're probably going to see some type of money come out if there is something that breaks this year. All right, so those are two key points. I'll keep bringing them up because they're the reason Wall Street missed this last year.
Yeah, there's an old adage, you never bet against the American consumer. Americans tend to spend more than they save.
Oh, yeah. Yeah, it's weird because if you look at emerging markets, they save at a much higher rate, and you think, well, that's kind of strange. Those are poorer countries in general, but they don't have the safety nets, right? They don't have the medical insurance like Medicare or Medi-Cal, those type of things. They don't have Social Security oftentimes and what have you too. So people are more dependent upon themselves. When you put in more safety nets, people feel like they can go out a bit more because they have something behind them. That's the theory anyway. All right, so then the other big report that came out this week was the gross domestic product. And this is the thing that really kind of jumps out at me because this is the essentially overall health of the economy, right? As we sit now. Now, this, again, stock market's predicting right now, in my opinion, a continued growth that is, good. So our average is around 3.2% is my memory over about a 10-year period. And you can see back in 2021, we had some really good growth going on. But if you look at what happened here, we just had a 3.3%, gross domestic product for the fourth quarter. Yeah. So they basically take the quarter, look at it, and they annualize it. If we keep doing that for the next, 3 quarters, this is where we'll be, 3.3. And if you look at the third quarter, we were at 4.9%. So for the second half of last year, we had 4.1% growth. That's actually phenomenal. And you had inflation coming down. That's not even a soft landing. That's actually a no landing scenario.
Yeah, which would be if the Fed pulls off a no landing scenario, everyone's really happy with that.
Yeah, because soft landing is super rare. I think the last one was 1994. So to have a no landing scenario, and again, government spending that comes in at the appropriate time and pent up demand is kind of the two things that are kind of making this work. And people are willing to go out. We were talking about it before the show. Credit card debt's growing, at a fairly high rate. Yeah. And someone was asking me, when can that stop, right? Because when do they hit the wall? I'll tell you what. One thing I've learned over the long term of watching the stock market and watching spending and watching the economy, things can go way longer than you think. Yeah. The 2000 run up, and it's incredible because sometimes logic just starts flying out the window.
Yeah, the market sometimes is played by human emotion.
Yeah, that's right. And eventually there is some point in time where that happens, right? It really does. And so that's why we ended up with a downturn in 2000, a downturn in 2008. People were buying houses they shouldn't have been buying, right? They kept going and going and going. It was incredible to watch that happen. And so, it could go on for 4 or 5 years before you end up with that. It might not, but I'm just saying you've got to be aware of. I keep hearing people on the TV, CNBC or whatever it is, talking about how, it's already too high, or oh boy, I tell you, they could be really wrong there. It could go a lot higher, and we're at an all-time high, but really we're just recovering kind of what we lost over that 2-year period. And so during that period, companies continue to increase their earnings. Yep. And, so things are not cheap by any stretch of the imagination. But, there's some expectations, I would assume, because the market keeps going up, that earnings will continue to grow. We have had a lot of earnings reports this, week. And, we're in earnings season. And so Tesla, missed their numbers, had guidance that was worse than expected, right?
Yeah, it's been hit or miss. I'd say like there's been a lot when the misses have been. There've been pretty major companies that have been missing. You got
Yep.
Intel miss today
Yep.
too.
Yep. Yep.
It's a lot more. It's not they're missing on their actual earnings. It's missing. It's kind of them lowering their forecast for the
Yep.
next year, their forward guidance, and that's what really concerns investors.
Yeah, exactly. Because Tesla did, okay on their earnings, a little bit of a miss, but then their forward guidance was worse, right? And now, having said that, there's a lot of companies done very well. I would call this a medium earnings season so far. Not great, but not bad either. And again, the market is setting all-time highs every single day. It is trying to tell you that things are going to be okay here in the near-term future, and that's what the market tells us. It's why it's going up. It's not going up because we did 3.3% gross last quarter, on the gross domestic product. That's why the market was going up before that, right? Mm-hmm. Now it's going up because there's some expectations that earnings are going to continue to grow. The Federal Reserve might be lowering rates this year. They might be lowering rates just because they're, and to me, the ideal scenario, because I can see two reasons you lower rates. One is a recession, something breaks. The other one is deflation, right? Lowering for deflation, that's a good sign. I think that would keep us rolling.
Yeah, because you're actually, when you lower for deflation, you're actually trying to increase the economy's growth rate.
Yep. And you would be talking up the economy. You would be talking up the stock market. I was telling Ethan before the show, I think the Fed stopped talking negatively about the markets and so aggressively, because one of the reasons that you would do that is because if you see things starting to slow down, you want to not have to change rates, then you let the market change it. And one of the ways you do is you let the market run. So the bond market goes up, the stock market goes up, people feel more wealthy, basically are adding liquidity to the system without having to change the interest rates.
People spend money when they feel good.
Yeah, they do it the opposite way also. Talk up the interest rates, talk down the market, tighten up liquidity, right? I think right now they're actually trying to make more liquidity available in their talk, in their rhetoric, so to speak. And so, we'll see how that plays out. But that's not a bad scenario. One of the things that happened, again, this is a pandemic-related inflation event. And as this money burns off that they sent out, you've got a scenario where more supply is coming online. There's more oil and gas. There's more, restaurant workers, whatever it might be, more people coming back into the workforce. And all of those things are really happening. So, just to finish up, just one last comment. So we got great growth in the economy for the last 6 months. We have 2% or less inflation on the measure that the Fed looks at. We have low unemployment, right? We have consumer spending that is really, really good. We have wage growth that is now higher than inflation and has been for most of that 6-month period, actually. Now, wage growth lost for a while to inflation. So we're making up, but we are making up. And so I think that's why consumer spending continues to do well.
Yeah, they're feeling better and better about how far their paycheck goes.
Yeah, so, if you're feeling like the economy is doing poorly, consider some of those pieces and consider some of those things that are actually happening and how things are rolling. Look at the stock market. The stock market is trying to tell you the economy is going to continue to do well. If we close today at a new high, that'll be the 6th day in a row at a new high, 7th day in a row up. As far as that goes, are we up so far?
No, we're down a little bit.
A little bit. All right, we'll hold our breath for the end there and see what happens. I will say, looking at the last couple of days, I'm seeing some fatigue in the market. Even though we did end up on those days, we were up quite a bit higher during the day and then kind of came back down. To me, that's sort of a topping sign. I would not be surprised at all to see some softness come in here someplace for some reason, maybe some other earnings reports that come out. I wouldn't even be surprised at all to see us retrace all the way back down to, the top of the all-time high. That would be normal. That's how it works, usually. This market is pretty hot. It might not do that, but that would be the norm. So anyway, that's what's happening right now. A good time to be an investor. Great time to be using a momentum system like we're using right now. And really you can ride these waves. This is a good time for the market. So anyway, look forward to being able to discuss this again next week and cover our summary. Thank you for listening this week. And so let's get into our questions.
So what is the deadline for IRA and Roth IRA contributions for the 2023 tax year?
All right, so you can make a contribution for last year up until April 15th this year, right? And so, generally speaking, you're better off putting it in at the beginning of last year, so your money could have been earning something. Market was up 24% last year. It would have been a great time to put money in.
A lot of times you weigh if you're on that borderline between a Roth and just a traditional IRA contribution, because you don't know, maybe you earn too much money to make a contribution.
That's right, exactly. There's a limit for a contribution. Now you can convert from IRA to Roth with no income limit, but if you want to add money, what is it, 6,000, 6,500, and 7,500 is the catch up. Did they change that for 2024? I guess. Can't remember. They seem to up it on a regular basis.
Yeah, they index it for inflation.
Yeah, so that's where you can kind of time that, but we do get a lot of contributions right at the end. Even on April 15th, we'll get people contributing.
Just remember, if you're trying to do a contribution for an IRA and you're going to actually deduct it, you have to do it prior to your tax filing for 2023.
Yeah.
But if you're not worrying about that actual deduction, you can do it after.
Yeah, we get a lot of that where, my accountant just told me, to add money to my IRA, and we put it on the tax return, and they're coming in with their check or sending us money to put into their account. So anyway, that's how it works. It's fairly straightforward. It's a great thing to do. Obviously, if you're at work, you can do 401k contributions, off of each paycheck. But
so it was 6,500 for our IRA or Roth IRA contribution, and another 1,000 for catch up.
And catch up is age 50 or 55? Sorry, we should know this.
It's after 50.
After 50, okay. Good. So anyway, if you're over 50, you can actually put in 7,500 if you want. Now you have to make 7,500.
Yeah, you have to have earned income.
Right, you have to have earned income. It's not rental income or dividend income or what have you. You have to have earned income off of W-2, 1099, and of those, you can, if you made 7,500, you can put all of it in there if you wanted. But if you make 5,500, then that's all you can do. Yeah. All right, good. What's the next question?
When should I start looking at long-term care policies?
Yeah, we've getting a lot of questions about long-term care policies in a lot of our appointments, partially because we're seeing companies really up the premium. Yeah. And some big companies that, were issuing policies 20 years ago kind of irks me a little bit, because these companies were selling to, 40, 50-year-olds, right, at what seemed like fairly reasonable amounts. And then all of a sudden, when these people are now 60, 70, 80, they're upping their policy premium amounts, in some cases quite dramatically, now because they're having to pay it out. So they've been banking money and not paying out anything for so long. In their defense, I guess, the cost of long-term care has really skyrocketed, mainly because the fastest growing area of long-term care is memory care, which is really expensive. Alzheimer's and dementia are growing the fastest. It makes sense when you start to knock down strokes and cancer and heart attacks. People live long enough to now have dementia and
so their body's going, their mind's going.
Yeah, and so but that's the risk the insurance company takes, and they're kind of passing that along. So what you want to do is you really want to kind of optimize when you get your policy. There are some risks, right? Because you could say, okay, I'm going to take it at a later point, but what if you don't qualify for some reason? Sometimes that can happen. I can't think of a client situation where prior to 60 they needed long-term care, but I'm sure it's happened. So keep that in mind. If you decide to wait to get long-term care insurance, hopefully you have enough money to cover it yourself, what we call self-insured, right? We could actually check that in a plan and see if somebody's self-insured by basically running the plan with a high cost of long-term care going out for 3 to 8 years. We can test out any dollar amount and any number of years also to see if, how that affects the person. But if you want long-term care or you need long-term care,
a lot of suggestions are around 60 to 65 if you're single, and if you're going as a couple, around 55. So that's what the AARP is kind of suggesting, and I've seen other similar suggestions around that age. Because the idea is that you don't know if you're going to ever need to use long-term care, so you want to pay premium. There's kind of like a sweet spot idea where you're paying enough premiums so your premiums aren't too high, but you don't want to be paying premiums so long that you're like wasting them in a sense.
Yeah, and I think one interesting point to point out here is that the AARP in this case is recommending different ages for different situations. So you're single, 60, 65, and if you're a couple, it's younger. And so here's the reason, in my opinion. Number one is that if you get it younger, then you do eliminate some of the risk of having a pre-existing condition by the time you get there. But the real reason, in my opinion, is because there's a bigger risk for a couple than there is for a single person. So if I'm a single person, I live in this house, and it's worth X, Y, Z. I've got these other assets, and I end up in long-term care. Somebody, my kids, whoever, can move me into that facility. They can rent my house, sell my house. Take my assets, deplete them all the way down if they have to. They're probably affecting their own inheritance, but in the end, the money's there to be used. As a couple, there's still somebody in that house.
Yeah, you still have to be able to live there. They still have to be able to live their life.
And you wipe out that asset base, you got a problem for that person you left behind. So this is where couples should be really paying attention to long-term care costs, potential. It's not something that's covered, right? Everything else is covered as a potential expense. Now, you might not end up either one of you needing it, and it could be a waste of money to do it, but so is a lot of insurance. If you never claim on your auto insurance for your whole life, you just wasted a lot of money in theory, right? But we still do it because the outflow could be quite high if the situation happens. The same thing with long-term care. So I think it's a really interesting subject. I think it's something to run through a plan, take a look at how it affects, your finances. If you're a couple, you should definitely be looking at this as closely as possible. And then there's a bunch of different options and such inside of these plans as to what you choose and how that works too. But we do have clients who have long-term care, who are in long-term care insurance need situations right now. And I can tell you very much so, they're appreciated that they have those policies because they can be quite expensive. All right.
So this question came in from chat. What's wrong with, or two questions came in. What's wrong with deflation? And the second question is, who should you take on the 49ers game?
Okay, so deflation as a consumer, we like that. Yeah. I mean, if prices are dropping and dropping and dropping, that's awesome, right? I mean, we like that quite a bit. But as a business, there is a production time for most services and most goods. So if I'm buying XYZ or paying for these things today, and then tomorrow I can sell them for less, right? It's a dramatic problem for business.
Yeah, because the idea is a business pays their costs up front. You pay your labor, you pay for the supplies, and then if you aren't able to sell as a profit, there's no point of being in the business, right? Because you're just losing money. So that's the idea, is when you have deflation, you start to risk that losing of money.
Yeah, so if I pay $10 to create whatever it is, a restaurant meal or a widget of some type, and I'm selling it for $12, at some point in the future, that's great. But if I pay 10 and by the time I get it out to, to production, I'm only getting 9, right? That's a dramatic impact on earnings. And so again, just years and years of reading about the Federal Reserve, at least what's written, they're more concerned about deflation than inflation, if they had to pick two things. And so when we get down to what we've had just now, where the core PCE, measure is 1.5%, if you annualize the last 3 months. If we get to 1.5%, you're going to see rate decreases. I guarantee it. And we're kind of there. I don't know. We'll see what happens. But the next big meeting, the expectation is that for the January meeting that's happening next week, they're going to keep it the same. That's fine. But there's a battle going on between the market and what the Fed's talking about for March, and so if we continue to get, these numbers, maybe there is a
they'll have one more PCE number before the March meeting.
Yeah, it might not be enough unless it's dramatic to make a cut. But then the next meeting is May, and the market's really, really expecting a decrease in May, and I am too. I think from what we're seeing here, I think that happens. In terms of the 49ers, actually, I think it comes down to matchups. The Detroit, doesn't do well against outside receivers. So Ayuk could have a really good game, and their linebackers don't cover very well, right? So Kittle could have a good game. And then you've got, Detroit has a really good rush, but most of that is at home with their crowd on that artificial turf. They don't do as well. The last outdoor game they played was against Chicago. They lost that game. They don't do well on that rush. So Purdy has some time. You got lots of weapons. Throw in Christian McCaffrey. They do well against the run, but he also catches.
Yeah, and I wonder how Detroit, they kind of have a two-headed beast when they come with their running backs, and so are the Niners going to be able to stop it? Because against the Packers, they weren't able to stop the run.
Yeah, I was kind of surprised how well the Packers moved the ball. I thought maybe the Packers would win that game actually for a period of time there. So, but I do think that sometimes you see these first seed teams, they're a little soft that first game. They've had to, sit, and the other team has had this huge win and this big momentum. I think the thing that's going with Detroit's way is just the emotions, and that can be it. That can be enough. So I don't know if they cover the spread, but I think they win.
I take the money line, but I don't know if I take the 7.5 point spread.
Yeah, exactly. So yeah, it should be a great game. Actually, both the games this on Sunday should be really fun. So
yeah, with Baltimore, I don't think Lamar's been able to beat the Chiefs yet.
Yeah, I think the overall team for the 49ers, home field advantage, it should be just enough to get that 3-point win or what have you, right? We'll see. And Deebo Samuels will be a question mark, and maybe it's just a decoy. Who knows? But we'll see how that goes. If he was in there, boy, that would be a really tough game for.
Yeah, if he was fully healthy, it'd be a totally different story.
Yep. All right. What's our next question?
Why is the U.S. economy defying expectations of recession?
Why is the U.S. economy defying expectations? The consumer has been. I think you mentioned it during our summary for the week, right? Doubting the U.S. consumer is not a good idea.
Yep.
I have been talking about since 2020 about pent-up demand, because if you look at the last pandemic, the Roaring 20s came after the pandemic, and there's just a psychological thing that I think happens. There's not enough occurrences to say that the data is sound, but I've been talking about this the whole time, that the consumer is going to continue to spend and would spend, even money they don't have. I was talking about that in 2020, and it's exactly what's been happening. And I think we're still going. I don't know, we're just beginning, but you'd be surprised how far out this could get if things continue to roll.
Yeah, because during the pandemic, a lot of people were saving extra cash, and now they're burning through those reserves. And then the thing is, once you start to live a certain lifestyle, it's very hard to change your lifestyle unless you have a significant event, whether that be a layoff, the stock market falls apart. Something has to trigger you to change.
Yeah, the 2008 changed everything, right? Yeah. So when that happened, boom, people stopped spending as much. It just it really, changed the whole picture as far as that goes. But prior to that, we had a fantastic run for quite a while. So there are other things that are driving the economy, I think, that are making it defy recession. Number one is there was a pretty big study, a couple studies actually done at the end of last year, showing that households had more money than was being reported. And so they still have more money, cash on hand to spend. And then businesses also had more money than expected. So both of them. And another report talked about how households refinanced mortgages and business refinanced their debts, right, at really low rates. So even though the interest rates came up, quite a bit here, 5%, 5.5%, they weren't really affected because, my mortgage is still the same it was. It's 2 3/4. It hasn't changed, even though they raised rates. If I went to get a new mortgage, so this is where I think there's a lag, right? And so it depends. If you're coming from one spot where mortgages are already kind of high and going up even higher, that's one thing. When you get down to historically low rates, right, and then you come up, there's going to be a lag. So people that need to move and get a new mortgage are now going to feel that pinch, right? Businesses that need new capital are now going to get it at a higher rate. They're going to start to feel that pinch. But I think what's happened so far is there's been a pretty good sized lag, and some of that will create a draw on the economy, definitely. Maybe this year, next year, what have you. but the consumer could still bail us out of that.
Yep.
Right?
Yeah, we could start to see, a lag on the economy. For example, startups. Startups usually need cash infusions on a constant basis. So once they've exhausted their cash, can they get more capital at a cheap price without issue? And that may be driving up. So that's why you can see a lot of layoffs in startups.
Yeah, because at one point the money was so cheap. These venture capitalists, they borrow it. These leverage, these big private equity companies, borrow. I mean, you see like a $9 billion company bought out on leverage, $7 billion worth of leverage, because the leverage, the loans were so cheap. Now you try to do that, the numbers might not work, right? And so you get less of those and less money coming to private equity, less money coming into venture capital. And you're exactly right. All the startups that are out there that are still running negative cash flow might have a harder time gathering that money. So, these are things that could happen going forward, but none of them have really happened yet, and that's why we've defied expectations.
Yeah, the job market is strong. People are having jobs and being employed. Unemployment is still below 4%.
Yeah, and wage growth is now still good. It is higher than inflation. That makes people feel like they can spend. There's still 8.8 million jobs open. That makes people probably feel somewhat comfortable, just knowing that they could probably go get another job if they lose this one. Maybe not be true in all industries and what have you. We're talking general across the entire economy. But nonetheless, I think that's, why we've defied expectations. And Wall Street was the most wrong I've ever seen in my 37-year career last year. And I found it a little amazing. I thought that there was a little pessimistic, considering what we were seeing on the consumer side, and it just kind of missed. They were looking at everything, not considering the pandemic. They were looking at all of the data, and they were right. We should have had a 20% stock market. We should have had a big recession when you raise rates 5%, but not in a pandemic. It's just not how it
They bet
works.
against the American consumer.
Yeah,
And lost.
Yeah, and they had money. Thanks to the government giving it out for quite a while there. So yeah, exactly. All right.
What happens if inflation drops below that 2% target from the Federal Reserve?
Okay, so Federal Reserve says that the core personal consumption expenditure, PCE Index, has to be at around 2%. That's their target. And then their second target is full employment, which to them means 4% or less unemployment, right? The last 6 months, that's what we've done.
Yep.
So when rates start to fall below that, and we get to what, if we annualize the last quarter, we're at 1.5%. They're going to lower rates, right? But I think we're already seeing some of it. We're seeing the rhetoric, the heavy rhetoric that started in November of 2021 that really drove the market crazy, made 2022 one of the worst bond markets in history, right? It wasn't just raising rates. It was the way that they talked about it, because they're trying to use what we call job owning to have the market make adjustments so they don't have to make as many adjustments themselves. So it's easier to unwind if they need to. So we're already seeing the opposite of that, where the rhetoric has died down quite a bit. People are, the Federal Reserve, Chairman Powell's talking optimistically about the economy. Janet Yellen's coming out and saying, yep, soft landing, just like I said. And they're really kind of taking victory lap, and they wouldn't be doing that. They probably deserve it, at least in this particular case so far. But part of the reason is because it makes monetary easing happen. When the stock market goes up, the bond market's had a fantastic rally too. And the bond market is, I've heard an analogy once that, because we talk about the stock market all the time, but if the stock market is a baseball, the bond market is a basketball. So the fact that that thing is gaining as much as it has gained here just, in the last few months, since basically since the end of October, there's a lot more wealth created here. And so that is designed to kind of offset deflationary pressure, offset, get that interest rate back, the inflation rate back up towards that 2% range. So we do have some slides here too, just to show you kind of, what the market's betting on. This is called the CME Fed Watch tool. You can go look at this at any time. It's pretty cool. This is the futures market for betting on what the Federal Reserve is going to do. So this is for the January meeting. You can see that's highlighted up there at the top as different tabs for each meeting. Yep. And so the expectation is that there'll be a 7.4% chance it's between 5.25 and 5.5.
So no change.
That's where it is now, right? So no change. So fine. There's never been an argument about January,
Yeah.
all right? But if we go to March here, there's only a 52% chance that it stays at that, and 48-ish percent chance that it drops, right?
Yeah, a month ago though it was closer to 80%.
Yeah, it was actually 83-ish percent. So and so it's definitely changed because we've seen some pretty good numbers come out.
Yeah.
Where it makes it look like the Fed doesn't really need so high GDP, great job reports, low first-time unemployment claims. All of these things that are happening that are, good consumer spending aren't showing slowdown. The Fed's going to say, oh, we don't have to worry about it too much. But I'll tell you what, the one reason they might do it is because the price drops come down too much, and that creates that deflationary pressure. So this will be interesting to see how this changes. And this is on March 20th.
Yeah.
So later in the month of March.
They'll only get the PCE for February.
Yeah, but there's other data that'll come too. I mean, so there's some time there where they might get back to a rate cut there. But when we get to May, which is the 1st of May, so okay, a little bit farther off, now that only has a 10.9% chance that it stays the same rate it is now. Mm-hmm. So essentially a 90-ish point or 89% chance that it drops, right? And so that's what happens when, the inflation drops below 2%. And I think that's the catalyst because I don't see a recession happening by May. Mm-hmm. I don't see, unless something crazy happens. And if something crazy is happening, that's not going to be in the expectations. That's usually something that's a surprise.
You don't bet on that.
No, it's a surprise. Something weird happening that we're not talking about. And those are the most dangerous things out there. And that's how it works. My analogy has always been the same. If you're walking down a dark street and somebody jumps out from behind a hedge, it's going to scare you. You're going to run, or your heart rate's going to go up. Versus when that person's behind the hedge, right? So when we're worried about the election or all these, those are all knowns. It's the unknowns. It's Lehman Brothers failing, which isn't something you would expect, and then finding out that it was a house of cards that it was sitting on, right? So those types of things. So anyway, that's what happens if rates drop below 2%, and I think that's why the market is guessing and betting that we will see some rate decreases here because the Fed doesn't want to go into a deflationary, time frame. All right, well, that's pretty good today for the show. Thank you so much for coming today. Really appreciate some good questions. Look forward to being able to, talk to you again next week. And of course, you can, send in those questions at any point in time. Just send them to this email address, asktom@talkmoneywithtom.com. We'll try to, get ready for those and answer those as they come through. And then, of course, you can, subscribe to our channel. I'm a big believer in trying to up your education. You want to have a good financial retirement. Try to learn more about it, even if you have an advisor. Secondly, of course, is you can just meet with us. Go to the book appointment button that's at the top of the website. Link to the websites on this channel, and set up a time to meet with Ethan and I, and we'll be happy to talk to you for half an hour at a place of your choice, here, video, phone, what have you. So anyway, look forward to being able to see you again next week. Thank you so much for coming today. Look forward to seeing you again next Friday.